We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
Like, I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just wanted a better financial picture.
And so when Earned came onto our radar and we sat down with our financial advisor, it just felt different.
I think a physician specifically should look at Earned because the focus is on our field. They know what a physician goes through at different phases of our career. To have that knowledge in order to guide us, I think is just such an advantage.
Earned isn't just about giving us financial advice. They're about doing the things that are needed to be done in order for you to fulfill your financial plan that they have created with you. And that really was very meaningful to me.
Earned is kind of like the conductor of an orchestra. You know, you pull in the trombones, you pull in the trumpets, you pull in the percussion. But Earned is the one that's holding the baton. I feel trust that they're taking care of my entire financial picture, not just one little part of it.
As a physician, I know that what I do for people is really powerful and impactful, and it's important for me to know that the level of expertise that I'm working with for my financial health is there, and I have that trust for them.
It's definitely valuable because I don't have to go looking a million different places. Like, I don't have a lawyer over here, and I don't have, the insurance thing over here. Everything's under one roof.
Earned brings clarity to my financial life.
With Earned, I feel really well taken care of.
I feel my financial health is secure.
I feel supported.
Earned is security.
I would highly recommend any doctor to look at Earned.
I love what I do, and it's really important for me that my patients have the utmost trust that I'm taking the best care of them. I have that same amount of trust with my financial advisors at Earned.
Hi, everyone, and welcome. Thanks for joining us tonight on how alternatives can cut your taxes significantly. It's the smart approach to asset location, brought to you by Earned and Physician on Fire. I'm Amber, Marketing Manager at Earned, and I will be your moderator for this webinar. Earned is a longtime partner of Physician on Fire and the first fully comprehensive tax and wealth firm built specifically for doctors, their families, and their practices. We bring tax planning, investing, retirement strategies, and practice level advice all under one roof so your whole financial life works together. Before we get started, a few quick housekeeping notes. We're excited to welcome you on our new and improved webinar platform designed to make registration, viewing, and interacting even easier for you. So if you look at the bottom right of your screen, you will see the question icon and the chat icon. Feel free to say hello, drop a question anytime. Nick will answer as many as possible during the Q&A event at the end of the session. So we're excited to have Jorge and Nick with us today. Of course, Jorge, as many of you know, leads the Physician on Fire community and has been a champion of financial freedom for physicians. And if you've joined us before, Nick Gizzarelli might be a familiar face. His expertise in advanced retirement plan design, tax smart strategies for healthcare professionals continues in this session as he dives into a new layer of wealth planning. Tonight, Nick will walk us through how to use alternative investments like private credit, private equity, and real estate, and how they can cut your taxes significantly while improving portfolio diversification and after-tax outcomes. So with that, I'll turn it over to Jorge to say a few words before we bring on Nick.
Hey, good evening, everyone. Good evening, doctors. I'm Jorge Sanchez from Physician on Fire. Excited to be here working with Earn. We've been partners with you guys for over 2 years. Alternative investments, man, what can you say about them? They can be great opportunities for diversification and tax savings. Today, I'm excited to talk with Nick about alternative investments, specifically talk about the difference between asset allocation and asset location. So that's a great concept that I'm still trying to wrap my head around. And thank you, Nick, for being here. Again, ask any questions on the side. We'll answer questions after the presentation. And without further ado, Nick, hey, how you doing, man?
Yeah, appreciate it. Thanks, Jorge. Thanks, everyone, for having me back this month. For those of you that joined last month, great to see you again. And always a pleasure to chat with the group here. Very engaging, great questions that you guys seem to bring with you. Some challenging, which I can appreciate. Just a quick introduction. I appreciate Amber for the introduction, Jorge. My name is Nick Gizzarelli. I've been with Earned and its predecessor for about 15 years. I am a senior advisor there working with high net worth individuals as well as business owners. And I sit on our company's investment policy committee, primarily around retirement focused strategies that we provide, with alternative assets being a key part to many individuals' portfolios and overall retirement strategy. This is a new platform, as Amber mentioned. If there are any technical difficulties, I have a team here who can help along. This is new for me as well, but we should be able to get through this together. So let's go ahead and get started here. So today, the agenda, before I jump into the key topic of alternative investing, there's a couple prerequisites that we need to cover. So we're going to talk a little bit about Roth, a little bit about diversification called tax diversification. Asset location is another key piece of the puzzle today. Then we'll dig into the meat here, which is alternative assets and what opportunities and also pitfalls that you may come across if you're an investor in this space. And finally, we'll wrap up with some quantifying, some modeling to see what kind of financial impact this discussion today could have on an individual, and hopefully with some Q&A here at the end. So let's get started. Last month, we took a deep dive into Roth. There are some major changes coming with Secure 2.0 that will impact many of you either this year or next year around how much you can save in a tax-advantaged account and how. So a little bit of a refresher on that. We talked about a couple things with Roth and how there will be an increased opportunity for many of you, especially those who are age 50 or older, to have a part of your retirement package designated as Roth. What comes with that are challenges around tax diversification and asset location. And so we'll talk a little bit more of those later on this evening. So why Roth? A high-level review. Well, first off, Roth is a tax-free vehicle once the contribution is made. So as a reminder, Roth is a contribution in which you don't get a tax benefit up front, but it grows tax-free and it can be withdrawn tax-free, including the interest that has accumulated over your career and over your life. It is, in a way, an inflation-proof tax shield because are no taxes realized when you withdraw the funds. You do not need to be concerned about changes in tax rates, changes in your own tax bracket that could impact your purchasing power in retirement. And of course, there's estate planning and personal financial planning advantages to Roth. Because Roth is a tax-free asset. So if you're looking to use it for your own benefit, or if you're looking to pass it on to your estate, onto your heirs, those who receive the benefit will receive a tax-free account. And the other piece that was very important during last month's webinar was the impact of Secure 2.0, which was a major regulatory package released a few years ago with a few key Roth provisions. And so just a quick reminder on those. There are higher catch-up contribution limits to a 401k and 403b plan for those who are ages 60 to 63. So instead of the about $7,500 extra contribution you are allowed to make, it goes to 1.5 times that or 150% that. That's important because the IRS has also said, and this starts January 1, If you are considered a high earner, which I anticipate many of you on this call are, any catch-up contributions you make, which are 401k deferrals over age 50, must be designated as Roth. So this is introducing or forcing many individuals into the Roth space, potentially for the first time. And finally, for those of you who are in retirement, there's something called RMD, required minimum distributions. Roth is exempt from this provision. So if you're looking to keep as much of your retirement savings in a retirement account through end of life, Roth offers an advantage because the IRS does not force you to take it out once you start drawing on your accounts in retirement. So why do we start with Roth? Well, the reason is tax diversification. So tax diversification is the idea of bucketing your investable assets or your assets of any kind into one of these three buckets here. You have a taxable bucket, such as a brokerage account, a checking account, a savings account. These are assets in which, as you realize gains, buy and sell stocks, you receive an interest payment or a capital gain or a dividend, you pay income tax on that as you go. So each year you would get a 1099 from the bank that says, based on your trading this year, you owe this much, you owe this much in taxes, give or take. Taxable buckets are great because generally you can pull some of that money out with minimal tax impact. And if you're strategic, you can isolate which types of assets you're going to buy and sell to minimize the tax burden. They can also be a pitfall because if you are not being tax conscious with your activities in a taxable account, you may be surprised at the end of the year with a big tax bill. Tax deferred is a pre-tax retirement account. Think traditional IRAs, 401ks, 403bs. You get a tax deduction for participation up front. It grows tax deferred, so you are not paying income tax on all the trading and activity in the account. But ultimately, when you cash it out and spend this money, you will pay income tax at that point. Third bucket, Roth, what we just talked about, you do not get a tax benefit up front. IRS gets to collect their tax dollars today. And in return, they say, if you keep this invested in this bucket, it can come out tax-free. Now, keep in mind, if you pull this money out early, you may lose that tax advantage status on just the earnings, the growth of the account. The money that you've put into these accounts will always be tax-free. They will not penalize you for taking that out early. So with these three buckets, a major question that we get, myself, my colleagues, and others get, is where will tax rates be when I retire? Or at least where will they be in the future as compared to today? Well, first off, I don't have that answer. And if I had that answer, every financial plan I built would be absolutely perfect. But this is the question that many individuals are trying to make their best estimate to, because it will decide what we should do today with our savings. For example, if you are in your peak earning years today, and you live in a state that has high state income taxes, there is a probable chance that you will be in the same or lower tax bracket when you retire in the future because you're near the top of the food chain today, right? Whereas if you are just ramping up a practice or you just joined a group or a hospital and you're still developing your career, there's a chance that your income is going to continue to climb and you may be in a higher tax bracket in the future. The reason why I give these examples is these are the types of decisions in the dynamic that an individual must consider when they're trying to determine, should I be saving in the taxable bucket? Should I be saving in the tax deferred bucket? Or should I be saving in the tax exempt bucket? Okay, having all three is definitely a great advantage. But there are always times when one may be more appealing than the other year over year. And so let's talk a little bit about the other side of diversification here when it comes to withdrawing. So not only does the idea of tax diversification give you total control of your contributions, it gives you more control around withdrawals. So the ability in retirement to say, I need to live on, let's say, $10,000 per month after tax. If I have all three of these buckets at my disposal, I can strategically pull enough money out of my taxable, my tax deferred, and my tax exempt so I can get that $10,000 while managing my tax bracket. You know, to give you the two extremes here, if I pull all 10,000 of that out of my Roth account, I owe zero tax, right? If I pull all 10,000 of that out of my traditional 401k, I'm going to get hit with the largest tax bill because it is all taxable. So having all three buckets gives you the ability to control, or at least have some amount of control over where you will fall in as far as tax rates, hopefully keeping more of that dollar in your pocket at the end of the day. Okay. So that is tax diversification. The last prerequisite that I want to go over here is asset location. And asset location, many of you probably heard of this, and it's not to be confused with asset allocation. So asset allocation is simply, should I have, how much stocks, how much bonds, how much real estate, how much should I have in each of the buckets? Pick a new term besides buckets because I've been using that previously. So how much will I have in each of these asset classes, right? So for example, I have a 70-30 portfolio, 70% in stocks, 30% in bonds. Asset location takes that portfolio and then breaks it up to say, okay, of those 70% in stocks, which tax bucket, where should I place those? Because there may be advantages to having stocks in one type of account versus the other. Same thing with bonds and same thing with other asset classes. So that's what we're going to focus on here for the next couple minutes, asset location. Okay. And the core principle is minimizing tax drag. And that's the core principle of a lot of what we do in the financial planning space, because the ability to consistently outperform the market from a performance standpoint, very difficult, if not impossible, to do over the longer periods. The ability to make tax smart investment decisions, much more manageable. And so tax drag refers to the the cost, the tax cost that you would incur for paying taxes from your trading and investment activities. You know, in a taxable account, if you trade that account a lot, you may generate extra costs, extra turnover, extra realized gains. Those are all tax drag. And that tax drag can vary depending on whether you're a long-term investor, a short-term investor, and what tax bracket you're in at the time that you realize that tax hit, right? So the goal is simple, like you see here in the box. Match the most tax inefficient assets, the ones that are most likely to generate taxable income, with the most tax advantaged buckets or accounts, such as Roth. And so we'll take one more example or one more stab at that here. So let's start with taxable accounts. Here it says they are best for assets with low turnover and favorable tax treatment. Well, why? Because taxable accounts realize tax, you pay tax as it happens. You don't get to defer it. You're not exempt. You pay that tax as you realize those gains. So we want tax efficient ETFs. We want potentially muni bonds, which have tax advantage benefits to them. We want potentially individual stocks because we can then be selective of what we buy and sell to manage that tax bill, okay? Tax deferred accounts, again, pre-tax retirement accounts is the main example here, or an IRA. This is generally where you would put funds that would normally spit out taxable income. Think of like a high yield bond. If it's earning 6% per year and it's spitting out interest payments throughout the year in a taxable account, that could get very expensive quickly. But in a tax deferred account, it doesn't matter because you're not going to see that tax bill until you cash it out. Same thing with high turnover investments. Real estate investment trusts oftentimes spit out almost like an interest or a yield. So those work best in something like a tax deferred account. Tax exempt, such as Roth, this is really where you're looking to put things that either have extremely high turnover, high yield bonds or funds or investments that would normally spit out a lot of short-term gains, as well as very aggressive investment options that are potentially those high risk, high reward type investments. And because there are two things we're looking at in Roth, like 401ks and tax deferred accounts, we're not getting hit with the taxes today. So we can be a little bit less concerned with the tax efficiency of the funds here. However, unlike 401k, we want this account to grow. I mean, we want all of our accounts to grow, but we are more incentivized for a Roth account to be more aggressive because that earning potential is also tax-free. So this is kind of the dynamic across the three different tax diversified buckets, and kind of where, in a nutshell, or in like a generalized sense, you would put each of those asset classes. So if I'm sitting back and decide, hey, I want to do a 70-30 portfolio, my second exercise, my second step that I'm doing is I'm then looking at all my available accounts. And maybe my taxable account would be 100% in stocks. Maybe my tax deferred account would be 50-50. Maybe my tax exempt account would be, 90-10. They would potentially have different allocations within the bucket, but my global strategy would target that goal, that 70-30. And so you will see in the tax exempt account bucket, there is a bullet point there for alternative assets. And if you recall, when we started at the beginning of the webinar, there was a little subheading about alternative assets being tax efficient or to save taxes. Well, it's kind of a statement that cannot stand alone. Yes, you can invest in alternative asset classes for a majority of reasons, and the primary being diversification and growth potential. But you do need to be careful about where you put these alternative asset classes in order to be as efficient as possible and maximize that tax savings potential that's available to you. All right, so let's go ahead. I think we kind of covered all the core class, ready to get into the meat of it here. This will probably take about 15 minutes to go through the alternative investments. That'll put us right near the end of time here. Well, with time for questions. And depending on how many questions here, we'll try to get through all of those. So talking about alternative asset classes, before I go too deep into those, common question or a headline that we like to use is, what's wrong with the traditional 60-40 portfolio? Well, there's nothing wrong with it, but there are better, or there are alternative options out there for investors these days. One thing I'm excited to see in the market over the last 5-10 years is some of these asset classes that have been around for a long time. Fund managers and investees, they are finding ways to make these available to the end investor in a more efficient, more cost-effective, and more liquid way, meaning you have easier access to buy and sell these funds. So it allows many investors today to look beyond the traditional, what we call 60-40 portfolio. With the way the market has been over the last couple of years, there's this idea of compressed return expectations with stocks and bonds. Forward-looking returns, most fund managers are saying are going to be lower for the next 10 years than they were for the last 10 years. Tighter stock and bond correlation, and I'll talk more about that on the next slide, but the idea is that investing in stocks over bonds, you do that because you expect a premium, you expect a higher rate of return. Well, that gap, that spread is narrowing. And while that compresses the total return of a portfolio, it does increase opportunity for you to maybe take some risk off the table. So we'll talk about that. And narrowing spread is really saying the same thing. bond yields rising, stock expected returns decreasing, that spread between those two asset classes has narrowed over the last couple of years. And to put that on a visual here, this blue line represents that spread. So the lower the blue line, the narrower the gap between bond yields and stock expected returns. So you'll see as of mid 2024, that spread was only 0.73%. So what this is saying is that you could choose to invest in a stock portfolio, which is 2 to 3 times as risky as a bond portfolio, but your expected premium or your expected excess return is less than 1% per year. So the lower this line is, the more attractive bonds become. And the higher this line is, the greater premium that you should expect from investing in stocks, therefore justifying the risk. Okay. So why do I talk about that? Well, 2 things. One, if you're in a position where you've considered de-risking, taking some risk off the table, now is an easier time than it's been historically to do so without jeopardizing significant return, assuming expectations become reality. 2, if you're in a situation where you can afford or you want to take risk, you want that excess return opportunity, maybe it's frustrating that there's less than a 1% spread, but you want something. Well, that's where alternative investments come into play. 3 of the key alternatives that are out there, and really just to back up a sec, alternative assets or alternative investments is simply referring to anything beyond traditional stocks, bonds, money market cash. So think of commodities, think of gold, think of private credit, real estate, private equity that we have on screen here, other things such as reinsurance. There are many different types of alternative investments out there. Some are more accessible than others. And so we are going to start today with just a couple key ones that we're seeing more interest kind of on a daily basis. So let's start with the idea of private equity. So what is private equity? Well, private equity is not an angel startups only where you are investing 50,000 and hoping it turns into $1 million. Private equity simply refers to investing in companies that are not publicly traded. So this pie chart on the right, of the largest 185,000 companies in the United States, you'll see just that small sliver is what is public. The rest, the light green, is the private sector. So private equity investing, if done in a disciplined manner, is tapping into the rest of this pie chart. So not just picking 1 or 2, but getting a portfolio of companies that may not be publicly traded today. Okay. Private real estate, just a quick touch on that. That's investing in properties for income and value growth, right? Real estate, I mentioned, is not the most tax efficient because in theory, if it's an investment property, while yes, it can grow with market, it should also be generating some income on a monthly or annual basis. And then private debt is also known as direct lending, and it's lending directly to companies, typically for a higher rate of return than bonds. So if the bond yield is expected to be 4 or 5% per year in the US, you may see private debt or alternative lending funds targeting a 7 to 9% rate of return, potentially even higher. Okay. And keeping with the private equity discussion, so looking at historical returns, annualized 10-year returns, private equity have exceeded public equity by about 4%, 4.2%. We're looking at 16.9% annualized for the private equity index versus 12.7 when looking at the Russell 3000. So this is looking backwards, but there are questions as to, why? Why has private equity outperformed public equity? And there are many reasons to consider that. Private equity is not as readily available. It's not as well understood. It's therefore potentially less efficient than the public space. And many of you have heard the idea of efficient markets out there, that data is absorbed and understood almost instantaneously, right? A headline comes out for the first time and prices will jump within seconds. Well, in the private equity space, we don't have that same dynamic. So that could potentially play a part here. And there is the idea of private equity potentially has additional risk. Some private equity investments are not as liquid as public. You can't trade them daily. Maybe you can trade them quarterly or semi-annually. As an investor myself, and most investors out there, if I am going to take risk, I better be rewarded for it. And so there is this idea of like a liquidity premium. So if you're willing to lock up money for a little bit, you should be rewarded for doing so. I mean, and this is the whole philosophy behind CDs, right? So that's private equity. I can tell you on Earned, we do offer private equity investing to our investors who have a high enough net worth. And it has been a very successful asset class over the years, as well as a diversifier, another type of asset that isn't directly correlated with the S&P 500. Switching gears here, just for the sake of time, I want to make sure I can touch on a couple of these key alternative asset classes. Let's talk a little bit about private debt or direct lending. So the top chart here is going back about 20 years of the annual income, the light green on top, that has been spit out from the direct lending asset class. And if you can't see the numbers here, it's in 2% intervals. So we're looking at the lowest bar being about an 8 to 9% annualized income or yield, with the highest being about 13%. And so this is year over year. On the bottom, you'll see the total return for the asset class. And the question immediately becomes, well, why aren't these more correlated? Why, if I am getting income from these funds from between 9 to 13% per year, why would my annualized rate of return be more volatile, where I'm seeing returns in the 5, 10, 15, and even one time in 2008, actually a loss? Well, there's one major type of risk that a direct lending fund has, and that's the risk of default. If I'm an investor and I fund 50 loans, so I loan out money to 50 different companies, and I'm demanding an interest payment of between 9 and 13%, there is a risk that one or more of these companies will not be able to pay that loan. So that is the underlying risk and dynamic of this asset class, is you are investing in something that's like a bond because it has an interest payment, but there is risk of loss in the form of default. Now, looking through this, the asset class itself has a very low volatility, meaning that the risk of default is low. And generally, investing in this asset class, you would do so in a way where you're well diversified. For example, the funds that we often use and put in our qualified plans, they have hundreds, if not thousands, of loans that they're sending out. So if one or more were to default, it would have a very marginal impact on the overall portfolio. All right. So I hinted about this a little bit on the prior slide. I'll say it again and with a couple expansions to it. So illiquidity, so risks and considerations for this asset class. Illiquidity. Now, this can be a risk. It's definitely a consideration, but it could also be a benefit if you're okay locking up some funds. Certain alternative asset classes are not daily liquid. Many of them, and the ones that we like to use, are called interval funds. And what that means is you can buy it just like a mutual fund. You can look it up on Morningstar, you can track it, but you're only allowed to redeem, you're only allowed to sell it maybe quarterly. And you think about it, this is important for a class like alternative lending. The fund is using your investment to fund loans to corporations. So therefore, they can't just keep enough cash on hand to pay everyone back whenever they want, or else they would not be able to confidently go make those loans and demand the interest payments. They would have to keep more cash on hand, which would hurt the performance of the asset of the fund and of the asset class. So oftentimes you see this on the real estate side as well. If you're investing in some sort of private REIT, oftentimes your money can be locked up for a significant amount of time, and it's for the same reason. They want to deploy your cash. They want to use that cash and generate rates of return. Well, they need the freedom to do so without being worried that you're going to come asking for a withdrawal while they're in the middle of their business activities. With that, there should be a premium. Every risk in the market comes with a premium. If a risk in the market does not come with a premium, well, that's a risk you should not be taking. Next is complexity. Depending on where you go in the alternative space, there are some that are very easy to purchase. You simply just place a trade. There's some that are very complicated to purchase. You have to open up partnerships and things like that. So it's important that you work with someone who knows this space, because if your goal is simply to get access to certain areas, such as private credit, private equity, there are very efficient ways that you can do that these days and still have a fair amount of liquidity. Access and fees. Many of these asset classes are restricted to accredited investors, qualified purchasers, or you have to work with an approved advisory firm. And generally, they tend to have higher fees than alternative investments. Many of the numbers that I showed you before are before an advisory expense, right? So you're getting access to an asset class that says it's going to generate 9 to 13% interest each year. Well, there may be a 1% fee on top of that that brings you down a percent. And finally, valuation. This is less important if you're using some of the asset classes that are in that interval fund style. But keep in mind, anytime you get off of public markets and you go to private spaces, a question you need to ask is, how often is this valued? What is this valued against? And is my investment value essentially protected, right? So with that, I'm not going to go too much into the real estate asset class. I think that one is could be a session in itself, and as far as an intro to alts, I think that one is probably more understood than the other two. But let's talk a little bit, let's circle back to the idea of tax diversification. So a mix of tax diversification, asset location for these alternative asset classes. Well, something like private equity is considered a equity-like investment, has higher risk, higher expected returns, okay? It can be somewhat tax inefficient depending on how you invest and how you access that space. But more importantly, that growth, that high risk, high reward potential for that asset class makes it a good contender for your tax deferred or tax exempt accounts to shield the taxable income while investing throughout your investment career. Also looking at the other main one, we talked about private debt. That one spits out, is very tax inefficient. One of the most tax inefficient asset classes you can find because it is spitting almost all of the gains that you realize from this asset class are realized in the form of interest payments. So interest payments, great because it's fairly predictable and it's consistent and recurring. So you have some liquidity there. Interest payments, especially short-term interest payments, can be a nuisance from a tax standpoint because they are ordinary income rates, taxed at ordinary income rates, because they are short-term gains that you're realizing 1 to 4 times per year. So if you're in a high tax bracket today, you've just created a whole nother source of ordinary income that you are going to have to pay taxes on at the end of the year. So because of that, it is very important to be thoughtful and strategic as to where you place something such as private debt or private credit, depending on what you call it. And most commonly, we see these in tax deferred or tax exempt accounts for that exact reason, to avoid the tax drag today and potentially shield it from tax in the future. Okay. Private real estate can go both ways. depending on how you are invested in private real estate, so looking at the green on screen here, there are two sides of the coin here. It can be fairly tax inefficient because it's generating income, but there are certain tax benefits to owning real estate directly where you can generate passive losses and therefore would make sense to have it in a taxable account. So I can't give you kind of like a, hey, here's a general rule of thumb for private real estate, because it really depends. Are you buying property directly? Are you investing in a partnership? Or are you going out and just buying a real estate fund? Those are all going to have an impact. What I can say is definitely chat with a CPA if you're considering getting into that space, because it is one of the more complex investment alternatives available. So let's do one last thing here before we go into like a model to see side by side. Talking about these alternative asset classes. So tried to give you kind of a base understanding of what they are. So what would you do with them? So what we're seeing is physicians, clinicians, whatever you may be, alternative asset classes, the why is you're looking for other sources of return, and you're looking for something that's either less risky or less correlated with stocks and bonds markets. So where we're seeing these fit in to an individual's financial plan or an individual's portfolio is by taking pieces of their stock and bond portfolio and moving those over to these alternative asset classes. And it can be done in one of two ways. If you're in a position where you say, I like the amount of risk I'm taking, I just want more return potential. Well, that's an argument right there to take some of your fixed income, some of your bonds, and move it over to something like private credit, or take some of your stocks and move it over to something like private equity, right? So you've maintained a similar level of risk, but you've increased the expected rate of return. On the flip side, you could say, I'm looking to de-risk. I'm at a point in my career, my life, where maybe I want to go from highly aggressive to moderately aggressive, but I want to maintain as much return potential as possible, because why wouldn't you? Well, that's an argument right there where you say, hey, maybe I can take some of my stocks, leave my bonds where they are. Maybe I can take some of my stocks and diversify those into some of these alternative asset classes where I'm reducing correlation. So my entire portfolio hopefully won't rise and fall at the same time. I'm maintaining similar expected rate of return. And I'm, in some cases, especially with the private credit, I'm reducing expected volatility. I'm reducing the expected risk of that piece of the portfolio. And then, of course, making sure you do all these changes in a tax efficient manner is just going to boost your likely outcome even further. All right, the last thing I got for you here, let's just do a quick side-by-side of one of the asset classes. Let's look at private credit. And what would happen if you took $100,000, you put it in a taxable account, let it ride for 20 years, versus $100,000 in a Roth account and let it ride for 20 years. Gonna make some assumptions here. Let's assume you're earning 8% per year. Let's assume you're in a high tax bracket today, 40% between Fed and state on your marginal tax dollars, and you're gonna let this sit for 20 years. Well, bottom line, you're looking at a taxable account ending value of about $190,000. Why? Well, the tax drag. While yes, it's returning 8% per year, that 8% interest payment that you're receiving each year is getting hit at ordinary income rates. So like a paycheck, IRS has taken a big piece of that before they let you reinvest those earnings in your portfolio. On the Roth account, that $100,000 is sheltered from that short-term tax rate. So it is growing, that full 8% is growing and being reinvested. Okay. So at the end of the day, you're looking at about $161,000 difference, starting with $100,000 value in year one. So that is a material difference. You're looking at the end of the day that if I took my taxable account, well, yes, it would continue to grow. I'm going to get hit with taxes as I go. I'm only going to have $190,000 in my pocket. You know, under the 4% rule, you can only take out $8,000 per year on that, or $8,000 per month, and that's going to drain pretty quickly. Okay. Final takeaway here, while saving large amounts, we didn't even talk about this, but saving large amounts is essential. The next step beyond, hey, save as much as you can for personal savings, for retirement, forever, whatever it may be. The next important thing there is do it in a tax efficient way, because at the end of the day, it's the after-tax value of any account that you own that is really going to be important, really going to be what you essentially have in your pocket to spend at the end of the day, at the end of the year, and at the end of your career. So things like tax diversification, asset location are key strategies that every investor should be considering regardless of how much they have invested today. And for those of you that are looking for strategies to get beyond what we call that 60-40 portfolio, considering things like alternative asset classes could help you target that risk return goal that you want, but continuing to be tax efficient and mindful is very important. So with that, just a quick couple disclosures. This was designed purely to be educational, not designed to give legal or tax advice. We are a wealth advisory firm, and our goal here is to educate you about all the options available. Yes, we do provide wealth advisory services, and are happy to chat with anyone that want to explore any of these asset classes or strategies further. But please reach out to your CPA, your legal advisor, if you have one, if you have any personal questions or anything that you read here today that may impact you directly. With that, Jorge, I wanted to pass it back to you for a second, maybe chat about this next slide here, and then hand it over for some Q&A. Oh.
Okay. So thanks, Nick, for that. Great webinar, very detailed. We've been working with Earn for over 2 years. They're a one-stop shopping affair. They take care of everything: estate planning, account management, wealth management. Definitely, everybody talks to each other in this company in terms of consulting. We also worked with them to create the POF mobile app. Number one, it has content. It has a top-tier content you can read all in one spot. It uploads your information, you can look at your finances. I call it your CFO in your pocket, because it gives you a great snapshot of your finances while you're managing patients. So great that. Make an appointment with Nick. They'll get you the information while in the meantime. If you have any questions during the webinar, Amber is going to take care of it. If you showed up late or you had to go because you had to take care of a patient, you're going to get an email with a link, and you can see this webinar in its entirety. It's really packed full of nuggets. I got lots of questions and comments on this. Hey, Amber, how you doing?
Hey, yeah, that was awesome. I agree, Jorge. Great content, super good insight from Nick. So there's some questions that we have from the attendees. Nick, are you ready?
Yep, let's do it.
All right. So our first question is, also, how do you vet the PE investment? The caveat looks like here is we get emails all the time to invest in startups, etc. Can you?
Yeah, great question. So I can tell you, startup versus PE investing, while related, are not all PE and private equity investing is in startups, right? Yeah, you do hear a lot of emails for opportunities to angel invest or invest in startups, which there are benefits to doing so, but that's like investing in the microcap space in the public markets. Like, that is the highest risk, highest return potential. Philosophically, the way Earned works is we generally target private equity investments that are valued at least around 100 million in gross revenue that they're bringing in. So these are established firms. We do go down market as well, but it is not something where we're going out and vetting true startups per se. That's going to be one small piece of the overall private equity portfolio. Oftentimes, and I'm thinking a specific strategy that we do use quite a bit, there are potentially 100 different private equity holdings in that investment portfolio, ranging from large to small company size. So that's kind of how we do it. We also, our back office, just to let everyone know, we do have on our investment committee, we do have an institutional advisory firm that currently manages over $350 billion in assets. And so collectively, we have a lot of knowledge and a lot of resources where if we have the ability to vet out a private equity opportunity, we are leaning on our PhDs and our experts and our statisticians to really look into that for us.
And Nick, just one comment to piggyback on that. I mean, I've grown and co-founded a healthcare startup, and I can tell you that investing in startups, you definitely have to be comfortable. You're right; there is a high risk. You have to have a good stomach for the ups and downs of investing in a startup. And then the second part is, a lot of startups deal with technology or products or services that are so brand new that very few people are experts on it. And I imagine you investing in something you don't understand or you think you understand. So startups, the best way is to invest through a fund that their portfolio is diversified and invest in 10 or 15 startups so that you're diversifying your risk rather than putting all your money on that. And that's what we call an angel investor, right?
Yeah.
Become an angel investor. You're directly investing, you're taking as much of the upside, but the risk is very high. So that's a good question. Amber, you're going to go on with the other question. Sorry to interrupt.
Yeah, no, that's great. Thank you for answering that one. We actually have a piggyback to that one is how do you identify startups or the PE to invest? And you did touch on this, but maybe you can go into specifics here.
Yeah, so and just to kind of expand on that. So as our company Earned, we are not in the business of directly going out and finding startups that we want to handhold to publicly offered, IPO. Instead, we're in the business of finding asset classes, high quality fund managers, and tax smart strategies that we can use for a physician's personal portfolio. And so what we identify, and I'll take this question and change it slightly. We don't identify startups. We identify portfolios of like the private equity asset class. We find funds out there that are institutional class, competitive on cost. Cost is higher in the private equity space, and well diversified. So if one of those 15 companies were to not perform as well as they had hoped, it's not going to jeopardize the total return of the portfolio. So that's kind of our approach. I could spend an hour talking just about the private equity funds we use. So if anyone wants to chat with me privately on that, please, take me up on that.
Awesome. Yeah, thank you. So the next question is, what's the typical net worth that is needed to invest in private equity?
Yeah, this is evolving daily. I mean, there was an executive order in the last few months where they're saying alternative asset classes may be allowed in 401k plans, like within daily liquid mutual funds, which means that everyone in theory would have access to alternative asset classes, right? Private equity historically was meant for those who had like $1 million in investable assets or more, were high net worth individuals considered either accredited investors or qualified purchasers, which are kind of like financial terms for high net worth individuals with a lot of cash to invest. What we are seeing is these new structures known as interval funds, where they're making it mutual fund-like structure, just with some restrictions on when you can cash out, is allowing more investors access to this fund. So we're seeing it now, like if you have 250,000 or more in investments available, that you can get access to some of these asset classes. Now, you may not have access to all the ones that we would recommend. Some still have $1 million minimum or $3 million in some case, but most of these asset classes, private debt, private equity, have entry-level options that are diversified portfolios.
Awesome, great explanation on that. All right, our next question is, do you have any thoughts or comments on ethics of investing in alternatives? Some of these asset classes, many not mentioned here, seem to have questionable impacts on the environment.
Yeah, alternative investments is a very broad term. We could be talking about precious metals. We could be talking about certain commodities. A lot of things that could have and potentially environmental impact. And when people talk about environmental impact, there's two reasons you talk about environmental impact. First is the ethics of it. You may feel strongly about investing in something that supports a positive direction in the world, socially, economically, environmentally. Two, there is a real financial reason that you would invest in someone who's environmentally conscious. In theory, a company that is environmentally focused may be less invested in something like fossil fuel reserves, maybe less invested in things that are more likely to be impacted by regulatory changes, right? So there is a real financial reason to consider that as well. In the private debt space, in the private equity space, and a little bit in the real estate space, we don't focus too much on the environmental impact on those, but you can also hear that those are the only three I talked about today really in detail. I can tell you as a philosophy, our firm does not invest in much other alternative asset classes out there, not necessarily purely for the environmental reasons, but it's just we find more value in the economic side of what we're investing in on those two or three that I talked about today.
Awesome. All right. So it looks like we have a backtrack question. So going back to the PE vetting question, what % return does PE typically expect? And what can you tell me about funding cycles?
Yeah, so private equity is, there's two types of private equity. If you're investing in a private equity firm directly or a private equity fund that's very narrowly focused, there's something out there called a J curve, right? You invest early on and the expectation is almost that you're going to lose money in the short run. And then it's gonna hit its stride. And the hope is that the back half of that J, sky's the limit, right? And that's the original thinking behind private equity. And with that comes the risk of, when you say funding cycles, I think you may say when they're going to come asking for more investment, more cash, right? Like if you're committing $500,000 to invest and they may come call for more money over time as you get through this J, we don't invest in those directly. We prefer and when I say we, I'm talking about the collective earned philosophy. I'm kind of putting my investment committee hat on right now. When we're vetting out and approving private equity asset class options, we are investing something that's a portfolio that's more well diversified. So while yes, the underlying fund manager may be monitoring those individual J curves of all the different investments that they are participating in, as a participant, as an end user of that fund, we don't experience that. I can tell, let me think if I'm allowed to spit out some returns here. I can tell you that the slide on the prior slide where it quoted private equity was about 4.2% higher. That's been pretty spot on to our actual investor experience that they have historically outperformed public equities. I can also tell you something that's surprising. The volatility has been half of the S&P 500. Now, will that continue? I don't know. But that is always a surprising statistic that I see myself when I'm looking at our own fund options that we offer.
Great answer. Yeah, I think that really helps explain a little bit deeper. Jorge, do you have any questions to kind of continue the conversation?
Yeah, I have one question. You mentioned a lot and it can be very confusing. Could you explain to me what we mean by correlated and uncorrelated assets, and how did this become practical in alternative assets?
Yeah, so the idea has always been that stocks and bonds are separate asset classes. They have separate risk, one's low volatility, one's high. They have separate return potential, one's lower, one's higher, and they're supposed to be not correlated. So if the S&P 500 drops, The bond market may rise or fall. They're meant to move independently. So whatever the stock market does, the bond market's not looking over there. The bond market doesn't care what the stock market does when it does its own thing. So when investing, if you have 100% of your portfolio invested in all things that are highly correlated, that means that if one goes down, they're all going to go down. If one goes up, they're going to follow the same path. Well, what we saw in 2022 was supposedly these uncorrelated assets, stocks and bonds, both tanked double digits and they became correlated. And the market, we're seeing an increased correlation in the bond market with the stock market that we haven't seen in some time. And so the question is, what do I do when both of these asset classes are dropping together? Well, yes, they might both rise together, but if I'm 63 years old and both decide to drop together, that's not going to work out well for me. I need asset classes that are not all highly correlated. And so that's where alternatives come in. And the perfect example to really sum it up here is there's an asset class I didn't talk about called reinsurance, and it's investing in the insurance market. And the example I always give, and I say there is zero correlation between the stock market and reinsurance. And someone says, well, prove it. I said, okay, when has the S&P 500 fallen and that caused a hurricane? And they're like, okay, I get it, right? Like they are not correlated. Well, that's a more extreme example of things like private credit, real estate, where the idea that a corporation needs to repay a loan, while yes, the idea of the S&P 500 tanking could hurt their cash flow, and if they were really stretched thin, maybe it could hurt the impact of them to pay their loan. The correlation between those asset classes is near zero, very low. So if I have 3 buckets, I'm going to have 3 buckets each with their own risk return profile and each moving independently of each other. So if you put those over the top of each other, it should smooth the ride of my entire portfolio.
Got it. One question I had was, so let's say I want to, let's say I just want to do a 401k in a Roth, and I look at that. Why not just stick to that? Why would I need to invest in alternatives? And the follow-up question is, you critique the 60-40 portfolio traditional split. Like what would be a recommended split? Is it 50-30-20? Where would I put the alternatives in this?
Sure. So the first part of your question is physician specific. Physicians have a compressed earnings window. They have high education, long education, high cost associated with that. And then all of a sudden they're thrown into their career where hopefully they see their income jump fairly quickly. So it's like there's a race and they're starting 5 years later than everyone else. So with that, the need to make smart financial decisions is slightly it's enhanced. It's more important for a clinician to make smart investment decisions. And when you're in a place like we are today, where the earnings or the expected return between stocks and bonds has narrowed, and both, if you look at Vanguard, they say the 10-year expected return for the S&P 500, they're thinking it's only going to be 5 to 7% per year. Okay, whereas bonds are 4 to 5% per year. And again, these are estimates. If you're a physician and you're saying, hey, I have a compressed window, I need to be very methodical, very disciplined with my approach, then I need to look at expanding and increasing opportunities for return without necessarily taking on too much additional risk, or it needs to be warranted. Now, the split of how you would do that, I could tell you philosophically, we generally don't put more than 15 to 20% of a portfolio in alternatives. It does vary case by case, but I bet you the average today is probably about 15%. What we see, if you're a younger investor, you may have a portfolio that's 70% in stocks, 20% in alts, 10% in some bonds, right? Or if you're someone closer to retirement, it may be 50% in stocks, 20% in alts, 30% in bonds. It just depends. We run a modeling software to kind of stress test all the portfolios. And so that's what we would do. But direct to your question, about 15 to 20% is what I see people considering in the alternative space.
Alternatives, okay. And then the next question is, when you talked in the slide on PE, private credit, and real estate, like what's the typical minimum investment for each of those?
Private equity used to be you used to need to be an accredited investor or a qualified purchaser. Generally means you need to make more than $300,000 per year. You need to have $1 million in cash invested. That has since come down quite a bit. I think now it's like 250K investment available for us to be able to get into that. Private debt or private credit, we can do on day one. That's something that is but however, to get into some of the institutional funds, you have to purchase it through an advisor. They do not sell to the public because they don't trust that the public understands the risks. So they want to make sure there's an advisor layer to really hold that investor to, hey, you got quarterly liquidity. Real estate, it's the full gambit. It just depends on how you're investing in real estate. There's public funds out there that anyone can get into. There's more complicated partnership style funds that you need to have a minimum net worth to get into.
Got it. All right, so everybody, we've been on the webinar for how alternatives can cut your taxes significantly. We took a deep dive into alternatives. I learned a lot. Diversify, my take point is diversify. Book your free consult with Earned. This is we've done many webinars with Earned. This is the second of a two-part series on just deep dives in just more detail. Thank you for all the questions. Thank you for stopping by, doctors. You'll get an email with a link. Check out the POF mobile app, and we'll talk to you guys soon. You have a great night. Thank you again, Nick. Thank you, Amber. Have a great night.
Thank you. Thank you, everyone.
Thank you all.